In a moment. Okay, so we'll start with Tom Williams, but we've got the recording going. Rita, is that right? Yeah. So welcome everybody again, and we'll kick off right now. So I'll hand you over to Mr. Tom Williams. Tom.
Thank you for that, Peter, Rita. Tom Williams here. Right, okay. I want Rita to read out the summary that we put at the end of last week's newsletter, last Sunday. Is that possible, Rita? Yes. Right, so I'll just hand it over and she'll read out the summary.
Well, yeah, because otherwise they don't know what I'm pertaining to. So, okay, point. Yeah. So the last bar that we were talking about, Peter, was the oh, there you go, that blue one there. Okay, here we have a blue up bar closing near the high. At this point, it certainly looks like an attempt. Oh, sorry. Well, this is the newsletter that we produced last Sunday. Last Sunday, this is the newsletter which is posted in the VSA Club every week. Tom does a weekly newsletter. This is a summing up the final bar of that newsletter. Here we have a blue up bar closing near the high. At this point, it certainly looks like an attempt to shake the market out. But we do note the volume is very low on this last up bar, which tends to tell us there is little or no demand in the market. We need further information, and we expect that to come Monday or Tuesday. If then you see a clear test, that is a red down bar on a narrow spread, probably closing in the middle, volume less than the previous two, that would indicate higher prices. However, if you see no demand up bars, especially on narrow spreads, that would indicate weakness. Tom.
Now, of course, that's all before it happened. Now, I'm not sitting here blowing our horns to tell you how good we are. Or we're just telling you how you should anticipate the market. So that bar here was the last bar last Friday. Monday, lo and behold, there's the test. Right? Now you can make money here, because when you see a test like that on a Monday, you know for fairly certain that that market's going to go up for at least a few bars. And you can, theirs is leaning out, crying at you to buy me. Right, a test is a down bar, a red down bar, right, on narrow spread, closing middle or high, volume less than the previous two. That's a textbook test. If you're writing a book, that's how you would describe a test. Okay. This is the Dow Jones. Can you put the S&P 500 up, Peter? That is the S&P. Oh, is it? Sorry, that is the S&P, right. But, okay. So there's a test, look. So come Monday, right, you could see that. You could immediately go long, knowing that's going to go up for at least 2 or 3 bars. That's how you anticipate the markets along those lines. Very, very important. And this testing is a test of the rising market because you've got strength here in the background. That definitely looks like a shakeout now, especially in hindsight. Right, so that's, please look out for these. Sometimes these tests appear on the Tuesday rather than the Monday, according to the various market conditions. Okay, now is that clear? Please, if you've got any questions on this subject or on this chart, please type in, and Rita's there looking at the screen and she can read it out to us.
Gillian is asking, how was the volume considered low on that blue bar? So I think it's the blue bar just before the test. How is that volume considered low, asks Gillian. And Jim W., what time frame are you referring to on your question? While Tom's answering this question, you can type that in. Thank you.
This is the end of day program. So this is the end of day chart, right? I always look at that first. It's like a roadmap, giving you a very good idea which way this market is likely to go or wants to go. Sometimes very, very clear. Now, why the volume on that bar is considered low? Because it's less than the previous two bars. That's the best way that we found to describe volume high, low, or whatever. If it's less than the previous two bars, relative to the previous two bars, it's low, isn't it? In actual fact, it's not all that low, but relatively speaking, it is low. It's low relative to the previous two bars, and that's what we're looking at. That's how we look at it. Now, we've got quite a few people in here listening to this. Could you type in those people that have little or no experience or want to know the basics of VSA? What is it really all about? Please type it in if you're new.
Yes, we have quite a few new people, Tom.
Right.
Yeah. While we're on this chart, question here. On the 23rd and 24th, we have narrowing thrust. So that's this one and this one. Does it mean weakness?
Well, nothing's in black and white, that easy, but as the markets go up, right, in a bull move, it's tempting a lot of the professional traders in there to take profits at some time. And when they do, that causes, because they have to sell or unload their holdings as much as possible, it has to be done on up bars. Right? There are no friends in the stock market. If they try to unload on down bar, the market makers would mark it down horrendously and they would lose a lot of money. So they have to do it as the market's going up. So they unload, but that unloading as the market moves up causes the spread to narrow. And that is a weakness that you need to observe. So yes, those last two bars on that chart, the last, it's today, Friday. It's up to date to yesterday, Thursday. So it's definitely some narrowing of the spread look. Now, to those of you that are completely new or newish to the way we look at the markets, right, it's once you hear the logical reason, you can't help but deny that this must be, because it's so logical, it can't be anything else. When you look, when we look at the market, we look at the volume to start with. Now, volume is a great mystery to most people, most traders, right? As a matter of fact, it's such a mystery that many firms give out charts with no volume at all on it. And they shrug their shoulders and say, well, nobody understands it anyway. It doesn't mean anything, which is a load of rubbish as far as we're concerned. When you look at those vertical bars below, you're looking at relative volume, right? And you're looking at the activity of the professional traders. Now, a professional trader, or Gavin calls them smart money, are those traders that are professional players that think nothing of having 40,000 contracts in there going at any one time. And it's that, putting those huge, large amounts of contracts or money into the market, right, is they can't do it without betraying their movements by looking at the volume. And of course, that's why we call it stopping volume, and so on and so on. Right, so the volume is very important because we're tracking the activity of professional players, professional money. And it's their activities that alter the balance of supply and demand. It may be altered, only altered for a few hours, but it doesn't matter. We can see that. Don't forget, my interpretation of these markets are usually what we use for scalping. That is, we're in the market for a few hours or so and then out. Hopefully we make a few $100 or even 1,000 if you do, and then we out of the market. And that's what we call scalping. Now, if it's long term, like you're looking at after your pension when you're old age or something, then you need to look at the longer term charts, like weekly, monthly, or even quarterly charts we have. And that will give you a good indication of the direction of the market. And now on that activity that you see, you can see that some bars are high, some bars are low, some peaks are average. There's an average line there running along there. That tells you the activity's average, right? On that amount of activity, you then look at the price spread. That is, what did the market actually do on that volume? This is the part of the analysis for you. What did the market actually do? There's a few things to remember. Professional money, when they're selling, they have to sell on up bars. Right, they have to sell into surges of buying which come along. If they're buying, right, they have to buy in the fresh low ground on low volume down, or you see stopping volume as the market falls, usually the fresh low ground, right? But they have to do that because they're up against other professionals. There are no friends in the stock market. They'll cut each other's throats sooner than look at them. There's no friends in the stock market, not when money's concerned. Okay? And that's what we look at. Now, we can more or less prove to you that what we tell you is actual fact and correct. Because if you look at this, especially the end of day program here, you'll see automatic signals that appear automatically without the intervention of any human being at all. Now, many of them have been running for many, many years, and they have not been altered in any way. Matter of fact, none of them have been altered. Right, and if you look at them and think, well, that's not bad, that's quite clever. That's not bad signal, right? I mean, one right here, look. If you put the cursor over it, press F1, that particular sign of weakness came up automatically, warning you that there's no demand in the market. Professional money are not interested in higher prices, right? Now, the reason I say we have automatic signals is because if they look fairly good to you, or they seem to work, then what that means is that the logic that we instructed the programmers to put into the program has to be correct. Computers simply do not understand mistakes, your mistakes. They don't understand it. You either got things right or you haven't. There's no emotion attached to them. There's nothing. It's like a telephone number. If you want a telephone number to work, every digit has to be clear and accurate. because if 1 is out, the computer can't say, oh, well, that 8 looks like a 3. We'll call it a 3. Computers can't do that. It's either black or white. You've either got it right or you haven't. And so you can be rest assured that what we tell you is, in fact, what drives these markets. Now, fundamentals are very good if you've got the time and expertise to do that. There's nothing really wrong with that. It's a lot of work attached to that if you can find the information. There is these formulas that people use has been standard for many, many years. Now, the reason why we don't, or I don't use the formulas is because there are too many very, very clever people out there. Believe me. You've got your Einsteins and all the rest of it stuck out there. And not only that, they're back with money. Now, if there was a simple formula, mathematical formula, that was more or less certain to make money, then they'd have been onto that many, many years ago. And as the formula was developing, right, the fact is that these people would have spotted it well before it materialized properly, would trade it out of existence. It wouldn't be there in hindsight because they would have traded it so much if they could guarantee it was going to make them money. Easy money, that is. And that's the reason why I personally don't think that's why they don't work. Unless you're lucky, you know, you may get something. But in hindsight, you look back, but they're there in hindsight because nobody's traded them. No big money traded them. Believe me, if they were traded, heavily traded, they would have been traded out of existence. Okay, so that's a rough outline of what we follow here. And you're up against professional money. They're not interested in you. They're interested in making money for themselves, and they will do it under all circumstances. So, is that clear now before we move on to another chart? So there's a test look. Very clear look. Even if we look down the bottom here, right, at the bottom of the chart, it tells you what if I can find it, here it is. Right, now if you were writing a book, right, first of all, describing a test, bar down, volume average, nice to be low, spread narrow, yes, closed middle, perfect. That is a perfect test. And when you see a test, you expect higher prices. That's why they test the market, look. And that was Monday. Sometimes you get that on a Tuesday. But now this week was Monday. But that's fine, because if you're aware and awake and look at that, you've got a grand opportunity to make some money with little fear of any loss at all on that. Right? And that's what it was pointed out in the newsletter last Sunday. That's what you need to do. You need to project your thoughts ahead, and if they develop, then you can jump on them. But the spread has narrowed somewhat, look, on these up bars. They're closing in the middle. That means there's a little bit of there's supply hitting this market. And the volume is fairly substantial, look, as it's increasing, look, slightly. Now, is there any questions before we move on?
Regarding the test, there are 3 questions, all really asking where would you enter the market on a test? Should you wait for the test after stopping volume? Where would you enter on the test bar, at the open or when the price breaks the high of the test bar? Things like that.
Well, we don't use any precise formulas. As soon as you see and recognize a test, as a trader, then you go in. Right? So as soon as you personally recognize the fact it's a test, and particularly here where it's come on a Monday, right, you will expect higher prices. Right, so it's nowhere, it's no good saying, well, I'll go in on this or I'll go in on that. As soon as you personally recognize the test as a trader, then you go in. Because we don't follow any formulas, there's nothing, it's an art reading these markets. It's no good trying to say this or that or that. As soon as you personally recognize it as a test is a red down bar, usually closing in the middle or high, volume less than the previous two bars, closing in the middle, and you've got strength in the background. That is normally a test, and you can bet your bottom dollar you're going to get higher prices. Does that answer that?
I'll ask these two questions. One is, what if the volume on that test bar had been higher than the previous bar? And the second question, however, the system did not put up a test indicator. Was there something detected that would have detracted from it?
No, I'm afraid the program, you see, I haven't had access to a programmer. I could improve this, of course, a lot if I had one sitting next to me who knows what they're doing. It's very difficult to find programmers that even know what you're talking about. And unfortunately, I haven't had access to one for some years, although we do have Gregory in Moscow now, who fills that category. But things will get better. But the reason there's no signal on that one, but there'll be signals at other time frames. It's very, very sensitive, the program. It has to be, because you're dealing with human beings. They're a funny lot when they trade. They don't necessarily do the same thing. They don't follow the same hymn sheet as everybody else. Right. Peter, can you put a 4-hour up? So what we do, we've seen the daily chart, look. Now we look at the 4-hour chart. Is this it?
Only because I'll just read out this question that came in a little while ago from Jim. I see, so he's talking about this chart and the 1 hour and the 15-minute on the ES. I see lots of indicators on the ES showing stopping volume, selling climax and 2-bar reversals. Are we waiting for confirmation with a test before a continued move up?
Now this is a 4-hour chart. I'll try to answer this question in a moment. This is a 4-hour chart, and I believe that was the test Friday, where the cursor is now, look. And lo and behold, there's the signals on a 4-hour chart.
Potential stopping volume.
Potential stopping volume. Next bar.
Bottom reversal.
Yeah, both signs of strength. Right. Now stopping volume is why we look at the volume, or volume is activity. Right. They can't hide the fact is that they're moving into the market. And we know they have to do it on down bars. There's a clear red down bar, and look at that very high volume. That can only mean one thing. The professional money have stepped into the market with thousands of contracts, right, and buying. So that's what they do. They have to buy on down bars, right. Next bar is reversed, up, and this we call a bottom reversal, which is also a sign of strength. It's reversed on the strength of that volume there. So up it goes, widespread up, right? Volume is substantial, but not excessive. So there's your shakeout. Now what we'd like to see now is a test. And lo and behold, the very next bar, that is a test, look. It's a red down bar. Let's look at what the computer says about it. Bar is down. Volume is low. That means there's no selling pressure. Spread is narrow. That adds there's still no selling pressure, because if it was selling, the narrow spread wouldn't be narrow. Close low, well, that's okay. So that is a classic test, look. There it is. And there's your low volume, look. Now, you might say, oh, it's on the average line, so it can't be low. But it is low relative to the previous two bars, look. Everything we look at is what we call relative volume. In other words, relative price spreads, relative volume. It's relative to the previous volume. And that's a test. And that's what that market went up, look. And the reason it went up because of that test. Right, now, markets don't like ultra high volume on up bars. And after an up move, look, bang, there's some volume coming in. Markets don't like that, right? So what do? They start immediately testing, look. And what we're looking for is volume low. What did I say? Relative to the previous two bars, it's low, look. And there we are, a down bar. So that's testing this high volume back here. So it's testing that volume there, look. Markets don't like high volume and up bars because that's supply. So they test it. There's the test. There's the volume on the test bar, look. Red down bar. And we can see that there's little or no selling. So that means the market's going to go up. Right? On the back of that. Now we see some more high volume here, look. Another. Sorry, get back here, look. There's high volume again, look. Markets don't like high volume and up bars. Now we even have a signal on this one. What's that say, Rita? Right. These are the dialog boxes. They hold the information, more or less what we know about it. So we don't hold secrets back. We don't tell you we have any secrets. What you see is what you get when you read. Don't forget, when you look at the chart, it's like reading a book, a story, like Braille, right? And the dialog boxes help you along that way. Supply. Markets don't like supply. But you're up against professional players in the background. They may want to hold a market up. And these red bars must be on lowish volume, look. But up it goes again. But now that's interesting because you see this bar here. Look at that low volume. Now it's a trick these professional players get up to. Right, they've seen this high volume here, which produced that red arrow. They've seen that. They're fully aware of that. So it goes sideways. Now they mark it up, look. Or it's been marked up by the market makers. Right? Now, there's no signal on that time frame. But look at the low volume. That's what we call no demand. Right? When there's no demand from professional players, as they mark it up, which they can do, right? It must be being marked up artificially. The players that matter are not behind the move. Okay, so that's sign of weakness. It reverses on that, look. You get red down bar, and then we get what we call an up thrust, look. An up thrust is when the professional players know perfectly well the market's weak. So they say, right, okay, we've got a chance to make a little bit more money out of them. We'll mark it up as far as we can, catch as many stops as we can, mislead as many traders as possible, then let it fall to the low. That'll help. That'll get some more money in for us. And that's what they call an up thrust, very common in weak markets. So down it goes. You'll always get a few up bars, but look at the low volume here. Look, no demand. Clearly no demand. So we know the market's still weak. Right, so it plummets down, a sign of strength, and there's some strength. This is the opening today. There was obviously some buying there. It plummeted down, very high volume, closing on the high. So there must have been some support there. Now, a lot of the high volume, of course, is caused because the American markets opened, the pits and everything opened up there. And that will create that extra high volume. But still high. Now, this is a 4-hour chart. Overall, you can see how it's mushrooming over. Weak markets have this mushroom top to them. And that's caused, of course, by every time they try to push it up, right, it fails just a little bit every time and starts dropping off. Any questions on that?
A gentleman here, I don't know how to pronounce your name, Bowden or Bodden. There's two questions, and one of them is on this chart, on our test here. And I think, Tom, that you were talking about a test being a down bar closing in the middle. Well, actually, it can actually close on the high. So he's saying on that date, it looks like to me that close is at the high and not the middle, and that's correct. And test bars can come in all kinds of shapes and sizes, actually. And it could be a narrow bar, and it can be a bar like that. You might not call that a narrow bar, but I suppose it is narrower compared to the others. But often, when it closes on the high like that, and what's very important is the volume is low, certainly less than the previous two. That's very important. And somebody else asked, what if the bar closed above the close of the previous bar? So that's still a test with low volume. But of course, you must have the strength in the background. So it's the background that's so important. So you must have buying in the background for a test to be even recognized as a test. So there are, in the VSA Club, and we keep mentioning this, and I keep forgetting actually what date it was, there is a webinar, should be a webinar done by a gentleman called Philip Friston, who has over 20 years experience in VSA, and he's a very reliable teacher, he's very experienced, and he did a webinar on tests, and in various shapes and sizes, identifying lots of different tests, and that, I believe, was in the VSA Club webinar archives. I don't know if it still is, but if it isn't, it's worth perhaps putting in a request to see it. And his other question was, when you have a down bar indicated in red, why can't you have a blue or green volume bar indicating that buying is occurring rather than the same red colour as the price bar? Well, everybody's individual with their tastes and with what they want, but actually my own, when I read this question, just because you have a down bar in red, it's not necessarily indicating that buying is occurring, is it, Tom?
It's usually lack of selling. The main criteria for test. lack of selling pressure from professional money. The big danger to a professional player sitting there with 50,000 contracts is that other professionals will try to make him take losses somehow, if possible. So they test the market, and if nobody's there willing to sell, that's what they're interested in. Lack of supply. Test is not indicating buying. It's indicating lack of other people selling. Professional money. Right?
Thank you to Robert and Park. It was the April 2011 Philip on tests. April the 6th. Join Philip as he explains tests, shakeouts and absorption volume. 2011. Yeah. Okay, so quite an old one, but nothing's changed. A test is still a test. That's it, yeah, April 6th. Thank you. How far, we're really on to tests now, how far should a test bar go back down into the body of the earlier high volume bar for it to be a true test?
No, it doesn't have to go necessarily to anything. Well, the main thing is that you observe as a trader that they've marked it down. It's down on a narrow spread, closing usually in the middle or high, and volume is less than the previous two, and you've got some buying in the background. That's a test. You're almost saying, like a shakeout, they're going to mark it back down to some other level. That's a shakeout. That's put there to shake you out of the market, catch stops. This is a plain and simple test. Very, very important. You can make a lot of money if you understand testing, as you can see by the test on Monday in the S&P and Dow Jones. Right?
Simon's asking, can Tom explain a hidden test? A hidden test.
I don't know where that one came from. There's no such thing as a hidden test. A test is you can see it. There's no point having a test if you can't see it. It's been picked up somewhere or other. The only hidden bit I know is an upthrust. Where they have a crafty upthrust, it's still there on view, but you're not expecting it there. I think we saw one on that 4-hour chart.
He said Seb Hanby mentioned it on a recording.
Who?
Sebastian.
No, he's got it wrong. Sorry, Sebastian.
He's not here.
Sorry. He's very clever, Sebastian. But if he said that, he's got it wrong. There's no such thing as a hidden test. Hidden upthrust, perhaps. And even that's not hidden.
Julius, a long time ago, asked for us to look at the US stock VMW. Could you put that? VMW. That's it. Oh gosh, it's going sideways terribly. Gosh, can you make it turn?
As soon as I look at this, I shudder, because this is an upthrust, look, and they only mark it up like that. They mark it up to deliberately to mislead you, catch stops, and mislead as many traders as possible, go the wrong direction. That's not a good, healthy sign. You've also got sign of weakness on the previous bar. What's that say?
Supply coming in.
Supply. Yes, high volume, look. High volume on that test, which is bad. There's supply in this market. Yeah, that is an up thrust. Well, that. Now, I don't know where this word hidden came from. I may have used it.
We have used it.
Have we? Sometime in the past. But you could see it's not hidden. As soon as that chart went up, I was horrified. As soon as I saw that. It was certainly far from being hidden. Now we look back here, and there's not really a great fall. To attract professional money in, you need a substantial drop. You need to reach a level where the professional money is going to become interested. And look, there's no stopping volume there, though we got a red arrow there.
Strength coming in.
Strength, that's why it went sideways, look, on that arrow, look. But there's no stopping volume, right? Therefore, we don't really expect that to go up as such. But there was a bit of strength came in there, enough to make that market go sideways, look. Right? But that's a sign of weakness there, and that is an up thrust, hidden or not, you can see that. Those are signs of weakness there. I would not like to be long on that stock at the moment.
Gillian is saying, I believe the hidden means that it closed below the close of the previous bar. A true upthrust still closes above the previous close. Is that correct? Possible, he said. Hang on. Julius says, it looks like weakness, but it has been very strong the last 2 days since the upthrust. Do you have any thoughts?
Yeah, there may have been a bit of strength coming in, right? But doesn't mean to say it's going to go on up to the moon or heaven, right? I said I wouldn't like to be long on this. I suppose you could trade very, very short-term trades. If you thought it was going to go up, you could go long. As soon as it showed weakness, get out. It was already shown 2 very serious signs of weakness in the background. Professional money are fully aware of that. They're certainly not going to trade against that. I wouldn't have thought so.
For William. Hello, William. In light of Tom's answer on tests, would Tom see today's down bar on the US stock HOG as a test? I am looking at the daily bars. Today's. We haven't got today's volume yet. Today's bar. Sorry. Is that straight?
Yeah, it's not a test. A test occurs once you've seen strength come in and it's sort of built a bit of a cause and the market starts to have a bull move. Then you get the test. The test that we really would love to see. But I don't like stocks that gap down like this. But it certainly looks like there's some buying on there. But that gap down is such a serious sign of weakness that even though there's some buying on there, look, high volume, that's stopping volume, right? Down in a fresh low ground, spread is fairly narrow, it's close in the middle, look, but the volume is massive, look.
Shakeout.
Yeah, shakeout. Although the computer figures that out, it may very well be right, but I don't like stocks that gap down. I says it must be something very serious going on here, because it's not normal for stocks that gap down like that. There must be something fundamental in there that we don't know about. But could very well have a little bit of a rally.
Right. There are so many questions, we won't be able to get to all of them. Here's one from Damien. Tom, what do you think about tick volume or activity from Forex brokers to analyze the market from a VSA point of view? I mean, from broker to broker, we have huge different tick volume or activity. Do you have a preferred Forex broker? So what do you think about tick volume or activity from Forex brokers for analysing the market from a VSA point of view? We have different tick volume from broker to broker. Do you have a preferred Forex broker?
Well, again, you see, to analyze the VSA way, you have to be very flexible. You're not sticking to any mathematical rules. There's no such thing. You have to visually recognize it as such. Now, tick volume is really good. If you can get fairly decent tick volume, because it really shows what's going on, really. And it's very, very good. But it's up to you as a trader to figure all that out. We have no hard and fast rules. Gavin is very good at answering those sort of questions. He likes to trade the Forex. But tick volume is generally, it's not misleading, even though they may differ somewhat. All right, they may differ, but not enough to affect your analysis. It's very, very good tick volume as such. I did have VSA running on proper tick volume years ago, and it make the signals even more accurate because the data, the information is more accurate. But unfortunately, I don't know what happened, but something happened along the way and we lost it. As I told you, I don't have access to a proper programmer at the moment because of Gavin's activities and things he was doing. But we do have Gregory now in Moscow, who's an excellent programmer, and he's rapidly getting online. But most programs don't know what on earth you're talking about, even though they're clever people.
On that note, Alan says, isn't volume on the Forex indicative of the activity by your broker's customers only? Isn't volume on the Forex indicative of the activity by your broker's customers only?
No, it's not. No, tick volume is usually taken direct off the exchange. The orders come in and leave in the exchange. Brokers don't base their ticks on the customer's activity, not that I know of, but again, ask Gavin, he's very good at all that. He's very close to Infinity in Chicago, and when I say close, he's very close to the owner there who will personally give him information.
It says, what exchange? There's no centralized exchange.
No, go on exchange. Oh, I see. There's no centralized exchange, but they do have in the exchange itself information that comes out. There's no central exchange, but if you trade Infinity, you get what Infinity uses. You have to, if you want precise details, but generally speaking, you can recognize and believe what you see in the tick volume that comes out as far as VSA is concerned. Don't forget it could be out by many, many millions. It doesn't matter because we use relative volume, and it's surprising what you get away with. If you're not asking for precise figures, it's just is the volume greater or less than the previous 2 bars? That's really all we're interested in. That gives us all the information we need.
Question here from Ed. Do dark pools limit the accuracy of reading the public markets? Dark pools. I don't know. Do you know what a dark pool is, Tom?
I assume it's groups. I assume dark pools, you mean traders that are bypassing the regular routes and trading amongst themselves. No, it doesn't, because they have to follow certain rules. The market, when I say rules, they have to follow the supply and demand of the market themselves, and that's what we're tracking. Generally speaking, you believe what you see.
It says trading privately, large players.
Yeah, that's right. Yeah, they trade amongst themselves. No, I think you can forget about that. Don't worry about things like that. I know from experience of these charts here that they're pretty, as far as we're concerned, they're accurate. Accurate enough for us to analyze it. But you'll get a lot of skullduggery talking about these things out there, people grinding their own axes and that, shall we say. But there are no real secrets in that. There are no secrets in the stock market. And if you hear people telling you that there are and they have them, then you know you're being groomed for a con. That's all I can say to you.
Okay, there's a question here. How do you recognize if the market is in accumulation or distribution phase?
Well, that's fairly easy because you know distribution phase. It can only occur after you've seen a bullish move, an up move, and then you need to see high volume and up bars, especially if they're up on narrow spreads. We have a signal called the end of a rising market. If you see that, that gaps up into fresh high ground, the volume is massive. That means it's the beginning of distribution. And then because they have so many contracts and they want to short the market and sell what they've got and all the rest of it, they have to hold, they normally hold the market up. And then it'll go sideways for some time as they sell more on every wave up. That's definitely distribution. You have to be careful with distribution because you know at the end of it, if they can, they're going to have an upthrust. In other words, they ram it up, catch all the stops, final mislead of many traders possible, then collapse down onto the low, and that locks them in. That's distribution. Accumulation is the opposite. You'll see the market, first of all, has to be in a bear market. It falls into fresh low ground, and you see what we call stopping volume. The massive volume comes in on the down bar, it then churns sideways, right, and then you start seeing testing, as we've been talking about. Then you know they're accumulating in the background now.
Thomas is asking, are the signals on the weekly charts more reliable than those on the daily charts?
Well, as far as I'm concerned, they're all the same. Admittedly, there are a few signals that appear that don't appear right, but in most cases, for example, if you see a green arrow, the market's falling. If you read the dialog box, it tells you ignore this signal if the next bar is not up. But can you put a 5-minute chart up of the S&P? About 5 minutes?
Yes.
No, it's a 5-minute chart, so it's obviously coming off a bit here. Now, okay, 5 minutes. So as the market falls, look, right, there's the start of accumulation. There's a very high volume on the down bar. That high volume or activity must have been buying. It caused the market to close up near the middle, look, top quarter. But that's the start of accumulation. Now, you might say, a beginner might say, well, that's not very good, look. The market still fell. Right, but let me go further. So the market falls, you get more spread coming in, more buying. Now, what we're looking for is a test if we're bullish. And lo and behold, there it is, look. That's a down bar, narrow spread, very clear test, look. Closing in the middle, volume less than the previous two. Now what's interesting is that we don't use point figure at the moment. But if you draw a line from that test, look, to where support first came in, if using point figure, you take your first count from there to there. And that will give you a very good indication of how high that was going to go. Now I can't elaborate on that because we don't have point figure. But unfortunately that signal would mark that, look. But that's definitely a test, look. Right there. You know what a test is? Well, let's look, see what the computer calls it. Bar is down, yeah, we know a test on down bar. We know the volume has to be low. We know the spread has to be narrow. And it's even close in the middle, look. Sorry. So it meets all the criteria for test, look. And there's even an automatic signal there, look. Test. So there's nothing particularly clever about that. Don't forget, these indicators have been there for 10, 12 years. And they haven't been changed, and they'll still be the same in another 10 or 12 years. You have to be alert to them. Now when they appear, right, it's up to you as a trader to spot them. To know if if you specialize in tests alone, nothing else, you probably wouldn't do much harm to your trading. Right? Now that's interesting. That's why it's gone up. Look. Now, markets don't like high volume and up bars. And there it is. They marked it up. Right. Now, don't forget, these signals have been in here for 10, 12 years. They have not been altered. And they will be there for another 10 or 12 years. They will not. The markets don't change because you're dealing with human beings. You're dealing with activity of human beings. And every time we get a blue bar, now, it's on no demand, look. Because professionals are fully aware this market's weak. Down it comes. Right. No demand, look. No demand is when they mark the market up. Market makers can do that, right? But it hasn't, not backed by the volume, because the professional players are fully aware that market's weak, and down it falls.
Okay, we're running out of time, but let's have one more question. Yeah. Right. Did you want to analyse the half? Have we done that, the half hour? Just to see where we are now for the market today. Yeah, Tom.
Well, we do have a shakeout in the background, look. Right there, look. So that's a fairly positive sign. We do appear to have some stopping volume here. but there's nothing positive. It's still falling on that. What we need to see, if we now see a test somewhere along here, then you will assume that it'll go up a bit. But it's certainly not horrendously bullish here, is it? You have to personally, as a trader, recognize these principles. And until you do that, you're walking on a tight rope, believe me. Very dangerous one. You have to learn to recognize the principle involved. Okay. Well, I think it's time for us to finish now, and thank you very, very much for listening to us. And I'll be doing a newsletter with Rita and Peter Sunday, which people seem to like. So I'll hand you over to Rita or Peter.
Okay, thanks folks for coming along. Hope you enjoyed it. Tom, as he says, is doing a newsletter on Sunday, and I hope we see you next week. So same time, same place. So with that, have a good weekend and a good week.